guys? Nolan Sanburn here. Usually we're talking about commercial real estate and investing in light industrial properties. Today we're going to do something a little bit different. We're actually flying out to Amarillo, Texas to go walk some oil fields with a friend and investor buddy of mine, Scott Puccinelli. And it's going to be awesome. Like I said, there's a lot of really cool things with commercial real estate. The cash flow is one thing, but nobody ever talks about the depreciation deduction that you get from this, and that's a huge tax benefit. Well, the oil and gas business is a huge incentive in the tax laws to go and invest, not only for the cash flow, it is a riskier opportunity, but the tax benefits are amazing with depreciation. And we're going to go over a lot of that today. Like I said, I'm not a massive expert in oil and natural gas the way that I would say I am maybe in commercial real estate, but we're going to learn a ton today, and I want you to come along and experience this with us. So on the next part of this video, you'll see us out in the oil fields. See you then. All right, guys, again, Nolan Sanburn here. I'm with my guy over here, Bill Griffith. We are in Amarillo, Texas on one of their leases. It's an 80-acre lease of a bunch of oil that I don't really know a whole lot about. And Bill is the expert. And Bill, give us what the hell we're doing out here in the middle of Amarillo, Texas.
Right, so this is one of our leases. My operating company called Kurzak Oil and Gas, we actually own and operate the lease here. We produce wells here. There are probably 20 wells in this one lease here. It comes to our tank battery where the oil is separated. We're about to take you over to where the water is taken. And this is oil and gas in a nutshell. We have various pump jacks around our leases that are pumping. All of these wells are on timer. They're not pumping 24 hours a day. They're pumping 15, maybe 20 minutes out of an hour on the wells that are producing. These type of structures, you don't want to produce it all 24/7. You want to let the oil feed back in and then pump it out, let it feed back in and pump that out. So we don't have that kind of flush production where it needs to be pumping 24/7.
Understood. Well, what we're doing today, guys, is Bill and his team, like I said earlier, this is a new opportunity. We usually speak about commercial real estate and purchasing commercial property. This is a really unique, cool venture that Bill has invited us to partner with him on. And so what we're going to be doing today is Bill's going to show us what the field looks like, how it flows into these batteries, what happens to the salt water, how they dispose of it, all of the ins and out mechanicals of oil production. We're going to go over the details of oil, the price per barrel, every single thing that you would need in order to discover if this is an investment that you'd like to make. And again, we'll just get you in touch with Bill and his team on that. So if you don't mind, let's walk. I want to walk over here one more time and you can explain. Maybe you've seen the movie The Rookie, where they always say, if you see these pump jacks going up and down, it means times are good.
Times are real good. Times are real good.
So elaborate a little bit more, like you said. So these pump jacks are out here on your 80 acres.
Yeah.
It all funnels into here. For someone that doesn't know, how does that, what does that process looks like from getting it out of the ground to getting it in your gas tank?
So you've imagined that our wells, and these are shallow wells, and when I say shallow, they're 3,000 feet deep. So we're extracting oil from 3,000 feet beneath the surface. These pump jacks are going, like I said, they're not 24 hours a day. They're about 15, 20 minutes out of an hour. They're pumping the oil, bringing it up to the surface, and we have poly lines, sort of look like rubber hoses that are on the surface, and some are buried, and they flow out from all of these wells. They flow right here to this tank battery or this gathering station. It comes here to this little heater treater, we call this. It takes the oil in there, separates the water from the oil, from the natural gas that comes with producing oil, sends the oil to our production tanks, and the salt water goes to that tank over there.
Give me a little bit more education on, you said a minute ago how these are shallow in the ground, because for me, when I was first getting, like I said, I'm an investor up in North Dakota in a saltwater facility in West Texas in Midland.
Yeah.
It's very intimidating when someone is initially getting into. So can you go into some details about what makes this style of investment so much less risky compared to the big loud people out there talking about fracking down
Sure.
and then going horizontal? Like what is the differences of different ways to extract oil out of the ground with the least amount of risk?
That's a really good question, and there's a big distinction here. So the wells that we have on our leases, these are very simple, traditional vertical wells, and they're very shallow. When I say shallow, 3,000 feet. In oil and gas standards, it's still over a half a mile deep beneath the ground, but oil and gas standards, it's a very shallow well. It's a kiddie play, okay? When you're talking about wells in the Permian Basin in West Texas or North Dakota, South Dakota, you're talking about horizontal wells that are down vertically 10,000 feet and out laterally maybe 15,000 feet. And you may need to do multi-stage fracs, blast a whole bunch of chemicals and sand to break up those that formation. And that formation is called a shale, right?
Yeah.
The Bakken shale. A shale is about as hard as your granite tabletop at home.
Wow.
But the oil and gas is trapped in that shale. In order to break that up, you have to do these massive fracs with chemicals, sand, water. That's when you hear about all these massive fracs, which is very expensive,
Yeah.
very time consuming, and very complicated. We don't have any of that here. We have just a simple porous formation that's feeding in oil and gas on its own. We don't have to do any type of fracking or anything like that. It just feeds on its own. Feeds into the wellbore. The pump jack brings it up to the surface, takes it to the poly lines, and takes it up here and separates it out here. And you're talking about these wells that you're talking about in the Permian and North and South Dakota. Those are just massive, massive jobs.
Yeah.
A well like that could cost, $15, $20 million to drill and produce it. A vertical well, typically, if we were to drill a brand new vertical well here, costs maybe $300,000 to $500,000, so a fraction of the cost.
Yeah.
Now, obviously, we're not going to get the type of production that you get in a massive horizontal well, but then we don't have the kind of risk as well.
Yeah. Well, you made a great point earlier in the car, just mentioning that all those guys that are drilling up in North Dakota, out in West Texas, trying to hit those big grand slams, there's nothing wrong with just getting on base and hitting doubles and singles.
Sure.
This is maybe the same thing as just getting on base with doubles and singles versus swinging for the fence.
Exactly. We don't mind that at all. The commodity prices are the commodity prices.
Yeah.
Oil and gas right now is a great price. I mean, we're between $70, $75 a barrel right now, which is a great price for us. Now, talking about oil prices, our cost to actually get the oil out of the ground, and once you take into our facilities for refining, cost out here is minimal.
Wow.
So you have a thing called lift costs, or cost to produce. What's your actual bottom line where you're profitable? What's the oil price where you're profitable at? Our oil price here, our lift cost here is right about $25 a barrel. So anything over $25 a barrel, we're technically in the black. We're in profit. The wells in West Texas and the bigger wells up in North Dakota, South Dakota, Bakken Shale, they could have lift costs or costs produced anywhere between $55 and $60 a barrel. So you have to be at $55, $60 a barrel just to break even.
So another great question that I think is important to answer is, a lot of people, like I said, they hear high risk, they hear high things. Like, again, we can talk a minute about the tax implications and the awesome incentives that they have.
Right.
But when you first got started in this business, kind of give your story about how you were working with another partner, and like you said, entrepreneur spirit in you said, I can do this better.
Right.
How have you created this business to making it the least risk amount and I guess creating the business specifically for investors?
That's a great question. In my previous life, we would raise capital from individual retail accredited investors to drill one or two wells at a time. And with that, the inherent risk right there is, like, if you're drilling one well and it happens to be a dud, well, all we get is a tax write-off, right? It's considered a dry hole and we lose all our money. All you get is a tax write-off, nothing after that. What I said when I bought this field, me and my business partner bought this field in 2022, we said, why don't we offer investors that same oil and gas type of potential, but let's offer them some safety. and there's safety in numbers, right? So what we did is we tailored a program where we're doing this over 20 wells. And we're not drilling brand new wells, we're just re-entering, re-stimulating existing well bores on our leases. Wells that we know have produced in the past, and get some indication of what kind of production we could have with a little bit of technology supplied in the form of stimulation. So we said, let's go and do a 20 well program on shallow wells. We're familiar with the techniques, we're familiar with the structure beneath the ground. So we have a really good idea what's coming out. We can't guarantee anything, there's no guarantee,
Yeah.
especially oil and gas, but we have a real good idea what's gonna come out of the ground. So, like I said, we have 20 wells that we're gonna do. On our current program right now, we're offering a 20 well package. People can buy into owning a piece of 20 wells.
Wow. Let's discuss the tax benefits, the depreciation, because for those that follow us know that the bonus depreciation with commercial real estate is a massive driver incentive for investing in commercial real estate. What are the tax incentives and, like you mentioned, the write-offs with oil and natural gas in the United States?
That's it's one of the key drivers that drives exploration in the U.S. is the great tax benefits that come along with it. If an investor comes in and were to drill his own well, let's say just for argument purposes, it costs him $100,000 to drill a well. You drill that well in September of this year, throw in $100,000. In February, maybe January, you'll get a K1 showing a loss of that $100,000. It's an accelerated loss, okay? Regardless of the outcome of the well. So that's one of the benefits of oil and gas is you get that write-off regardless. In 2017, President Trump signed an executive order making that write-off 100%. Prior to 2017, it was an 80% write-off in the first year, with the remaining 20% amortized over the remaining 4 years. Executive order in 2017 was written by Trump, and it's been in place since. And I don't see that going away. It may go away, may go back to the 80%, but for now we're still at 100%.
Another great piece about this too that Bill can maybe touch on is, as you guys know, the only way that you can take bonus depreciation or that accelerated depreciation against your income is if you're a real estate professional, where there's a couple of rules. You got to be in real estate for 750 hours. You have to spend over half your time in real estate. What are the rules to take this depreciation against your active income?
There are no rules. You get my company, our CPA an investor comes in, they write a check this year, they're in the program. January, February, you'll get a K1 from my CPA, from us, showing an immediate loss of, in this case, an example, $100,000. And you apply that K1 to your own personal taxes. Sure, all you fellows have your own CPAs and whatnot, smart CPAs. They apply that K1 to your own taxes. And typically you get to, as an adjusted gross, you get to subtract that out from whatever income you're making on your 1040s or wherever you file your taxes.
Yeah. So there's a couple of things that are different with oil and gas than with real estate. So the reason why it might be intimidating out of the gate is because you don't have great guys on the ground that you can trust or that have experience in this. But also too, you can't use debt in this. You have to inject equity, which is if you follow me, you know that I'm all about using debt. So it's a little bit of a different ball game on here. So when someone has the desire or is looking to partner up with you, what would the next kind of steps look like to get into business on one of these wells or other wells in the future?
We have to speak to each potential partner or investor that comes along that's interested in this. Want to make sure they're absolutely accredited and that they understand the risks involved with oil. It is oil and gas at the end of the day, and there's a possibility of losing all your money. But in this case, we're talking about 20 wells. There's very, very small chance of that. But we speak to the fella or a couple or business owner and make sure that they're accredited. Kind of do our own get to know you, vet the potential investor, and there's some simple paperwork that we complete together. We can do it online, and get it done. And they're a part. They send in or they fund their investment either through a wire or a check, and they're a partner. Get the updates, and then as we bring wells on, and when we close this program out, 20 wells are producing. We get paid on the revenue on what we sell then each partner is paid their distributed portion of the revenue.
Yeah.
On a monthly basis.
And what do they say? You know, the past performance can't tell you what's going to happen in the future. But like with ballparks like this and this site,
Yeah.
you know, what's kind of a ballpark, middle of the fairway like style of return that you're seeing?
You know, we just based our numbers off, if we took what we know these wells can produce without the stimulation, so we're producing between 5 and 6 barrels of oil per day. And that doesn't sound sexy, and it's not. It doesn't sound like a lot. But if you multiply that over 20 wells, we're only talking about 100 barrels of oil per day. And we did the math on 100 barrels of oil per day at $75 oil. That's paying right at about a 36% annualized rate of return, cash on cash.
Wow.
So,
without even including any of the tax benefits that you would get.
That's
just straight your cash on cash return, which is
exactly,
pretty strong.
Exactly.
Now and again, guys, this is like Bill said, this is oil and gas, right? There is risk involved in this, so don't take this as the only thing that you can do. But if you have extra cash, especially at the end of this year like this, this could be an awesome play for the tax benefits because you're able to take what is usually a passive loss to offset against your active income and potentially get higher rates of return that you might not have with a real estate transaction. Now again, with real estate you can use leverage, other people's money. Here you've got to use your own, but you've got great partners in Bill and his team that, like you said, we're trying to reduce the risk down as much as we can. And these wells have already been in production in the past. All right, well, as we keep moving on, I'm sure we have more questions.
Yeah.
So we can just keep this party rolling.
Yeah.
Okay, Bill, where are we now? We were just over there at the battery. You can see way back in the corner here. Now we're up at one of these pump jacks. Tell us a little bit more about this.
These are one of our wells. This is labeled as, the label's actually on the other side. This is the Smith lease number 4 well. So this would be called the Smith number 4. And this is your typical pump jack here. And it's on timer. It's not producing 24/7. Produce probably 15, 20 minutes out of an hour.
Wow.
So every now and then it'll kick on and it'll start pumping and taking the oil to these poly lines I talked about. These poly lines go all the way to our tank battery, which is what, about a half a mile that way, quarter mile that way. And this is it. So multiply this by 22 wells on this field and this is what we have.
So here's a question too. So with all of these, if we know that, let's say all 20 of them produce or 18 of them produce or whatever the number is, how long do we know that they're going to keep going? How much oil do we know? And why not go and try and put one right here, one right here, one right here, and just extract, just deplete it all? Well,
right.
That was a couple of questions in that, but.
So there's some geology questions in there that I'm not, the smartest guy to answer those, but the typical extraction on these types of vertical wells, you can go in and re-stimulate, like we're trying to re-stimulate these, and bring them on for another 3, 5, even 7 years. The question about spacing, the Texas Railroad Commission, state of Texas, requires spacing. Minimum acreage here, I think, is 40 acres, so you got to be a ways apart. You can't put 2 wells right next to each other.
Understood.
If there were another lease there, I'd go right next to their lease and take out of there, but
gotcha.
Texas Railroad Commission frowns on that. So.
Understood.
Yeah.
So give us some details on like your investor splits, like the on like a $100,000 investment from somebody. What is a typical equity split? What is that? What does the money do? Like give us some details on that.
So in this particular, the way we structured this, we structured it as a joint venture. And the joint venture is going to be owned 90% by investing partners and 10% by my operating company or us.
Wow.
So the revenue split, the investors are getting 90% of the revenue. We're getting 10%.
Wow. It's pretty generous.
It is.
Pretty generous in my book, I'd
because
say.
When we designed this, I said, having seen what other companies done in the past and what we've done, I said, how can we really put the onus on us and give the investors a real good shot at making, what you want in oil and gas, but some safety and make it attractive as well.
Sure. And in your case, 10% of something's better than 100% of nothing.
That's exactly
and
why
not to
we do
mention,
this.
if you do something like this and it succeeds, you're going to have people lining up out the door to want to do more.
That's the plan.
This is one site.
Yeah.
Give us the details on, when you're going to be closing this investment round, and then what's kind of on the horizon? What's kind of coming next?
Great question. So our current program, like I said, it's a 20 well re-stimulation, 20 well. It's on a different lease. and there's 20 wells that we're going to be doing that. We're going to wrap up the funding on that at the end of November. So whether we're fully subscribed, undersubscribed, or oversubscribed, we're closing the program out in November. And we anticipate having all the work done on all 20 wells by the end of December, so that our first payout, so the investors in this first program will have their first revenue checks February or March, and every month thereafter.
And not to mention all the depreciation for this tax year.
That's correct. And that'll be, the K1s will be generated at the end of January, beginning of February, right around that time. I've already given my CPA heads up, says you're going to be getting a lot of partner info and need to get those K1s out. Our next program, we're going to do something very similar. It's going to be similar in structure, but it's only going to be 15 wells. We figure we have a better idea of how the wells are responding, so we can lump those up. We've already mitigated the risk on 20 wells. We can shrink that down to 15 wells, still give a great return. Now we're only talking about 15 wells versus 20. Sure.
Okay, exactly. Let's keep on moving to the next one.
Yeah. I think what a lot of people fail to see or are unable to see, just because of the way the nature of investing in oil and gas, it's a little intimidating. You got to know somebody. You almost got to know somebody. But once you're familiar with it, and once you're familiar with the tax write-offs, and really the simplicity of it, you're paid based on how much you're producing. That's it. Once people see the ease of it and the great tax benefits that come along with it, people love it. They want to be in the know. They don't want a whole lot of people knowing about it.
Yeah. And I'd go a step further, and it's like you said earlier, for me, I'm kind of a little bravado. It's cool to be able to say, hey, I'm invested in this awesome site down in Amarillo, Texas.
Right.
That you said, it's not an everyday thing that you get to just participate in as an investor.
But it's not for everyone, right? You got to be a little bit of a risk taker, a little bit of an alpha characteristic to that,
Yeah,
Sure.
No, 100%. And, talking about just the perfect investor for a site like this, what comes to mind, and you can go a step further, what comes to mind is, like you said, someone that has a desire to get higher returns, but in exchange for that, a little bit higher risk. Someone that has maybe a net worth anywhere from $2 to $10 million.
Right.
Multiple six figures of income and disposable income.
Right.
And again, not afraid to, not necessarily swing for the fence, but is not okay with accepting 6% returns in a mutual fund that their uncle sold them as a financial advisor.
Yeah, I couldn't.
Because I've experienced that myself.
Yeah, no, yeah, that's exactly right. That's it in a nutshell. And what we found typically is that, our investors, they're all accredited. For the most part, they're on the wealthier scale. If you took a cross section of the population, they're a little wealthier. And to a man, to a woman, most every investor has three things in their portfolio. They have equities, they have real estate, and guess what? They have oil and gas.
Wow.
So, some direct participation in oil and gas as well, not just the equity part of it.
And I think what's cool about this opportunity, not just for myself, but for other investors watching, is we've got a guy now. Everybody that you have to do anything that's out there, you can't just do something kind of by yourself, especially if you're new. It requires a guy, somebody that's not necessarily, insider trading, but is on the inside and like, hey, we've got this new site. It's only exclusively available to these people. And I'd say, Bill, you're definitely that guy for us.
Yeah, that's, thank you, Nolan.
Yeah. And this doesn't, like you said a minute ago too, a site like this, this, for whatever reason, this just feels less intimidating now that I'm out here. Someone that is wanting to do oil and gas or has that appetite for a little bit more risk.
Sure.
Because like I said, this is my first time ever being on an oil field like this. I didn't know what to expect, and I'm like, all right.
Yeah, it's not what you're thinking.
It's not as the conglomerate. It's not as big and scary. It's more of like, hey, this is more digestible.
Exactly.
Maybe that's a good or thinking, hey, how are you supposed to eat an elephant? That's just one bite at a time right there.
It's mom and pop kind of feel to it, right? It's small enough to walk into it. These tanks, these aren't these 3,000 barrel tanks. They're small tanks. Small batteries, smaller pump jacks. That's how we want it. That's what we want it.
Yeah.
For our scale of business right now, that's how we want it.
what are the risks? I mean, I'm trying to poke a hole in this for myself, and because Scott mentioned it earlier, but it's like it's almost like it's you have a higher chance of every one of them producing versus all of them not producing.
Right.
Like what is, if someone is looking at this opportunity, what kind of risks just jump out to you or would jump out to an investor?
So when you're talking about, let's do this on an individual basis, right? If we're talking about one program, and typically how companies in the past have done this, one well, you raise X amount of money, you get X amount of investors, you put the money in. If it comes in, great. If it doesn't, or if it comes in mediocre, you're just left with that. That's all. That's a risk. So it's called a dry hole risk. There's always a possibility of a dry hole. We could lose all our money.
Yeah.
And there's nothing, all you get is a tax write-off. In this case, since we have 20 wells, we've mitigated that. So the real risk here is that for us to drill, technically we're drilling 20 dry holes in a row. We'd have to fail 20 times in a row. I can tell you from where I sit, if we failed 2 or 3 times in a row, we'd probably go back, re-engineer, and rethink what we're trying to do. To do this 20 times in a row would be, to me, idiotic.
Yeah.
So that's the real risk there. And very similar to the tank battery at the Smith, this is our tank battery here at the Rest 160. Let's go see if we can go see if there's some oil in there.
Yeah. So you got guys coming out here every day and just checking, basically?
Yeah. The pumper actually comes in and checks the level every day to give us an idea of what we're producing. Oh, look at that. That's money being made.
Liquid gold.
That's
Liquid
money
gold.
being made.
And it just never stops. I feel like it's just like an ATM. I mean, every day it's just...
That's the beauty of oil and gas, is that, you're not... I mean, granted, there's a lot of work involved in upkeeping it, but, it's on timer. So every 15 minutes of every hour, it's producing.
Man.
Overnight, it's producing. Winter, rain, snow.
Wow. It just keeps coming.
Yeah, that is a workover rig. When we talked about the work that we're doing on the 20 wells, so in one well, what we're wanting to do is throw down acid into the wellbore, re-stimulate the structure in order to feed more oil and gas in. That's what we're doing in a nutshell. In order to do that, we need to pull out all the existing casing the oil is coming in through. Pull all that out, clean the well. In order to do that, pull out 3,000 feet of string of casing pipe. You need a workover rig like that, where it goes down in, takes it out, puts it all on the side, so we're able to go into the wellbore, the naked wellbore, and do our work, our acid stimulation, so we can feed more oil into it. And then the workover rig will put all that casing back in. We put the wellhead back on, or the pump jack back on, and we're producing it. See, it goes in and it pulls out.
Yeah.
You see all that tubing right there? That's casing. That's where the oil is actually fed into.
Okay. From them taking this piping out like this, what's the timeline of getting that back online?
So from here, it looks like they're probably a quarter of the way done.
Okay.
And once you do the acid job, you'll probably, you could have this well back online here in about 5 days.
Damn. So this is an opportunity that a lot of people don't think about. Obviously, if you're following the channel, you know all about the 1031 exchange, which means you've purchased the property, you're selling it, and you're going to exchange it for something of higher value, and you can defer the capital gains tax and kick that can down the road. What you can actually do in a site like this is if you've purchased a piece of real estate, whether it's single family or commercial real estate, you can actually 1031 in your profits into one of these sites and defer the capital gains, still get all those tax benefits, and then also have a likely or higher cash on cash return than maybe something more stable like a smaller triple net lease deal. So this is a pretty cool opportunity if you're in that position where you've got a 1031 exchange coming up that you know you got to place that in, you need a mediary. These guys will be more than happy to talk to you about your specific tax situation with their accountant and your accountant, and you can decide if this is the right move for you or not in your situation.
What we're doing right now is the re-stimulation is we're throwing acid down the wellbore. And the best way to describe it is you got let's say you have a wellbore that's got perforations, a hole where the oil comes in. It gets clogged up over time. The acid would just clean it out. Kind of steam clean the perforations to let oil and gas flow back in.
Wow. Okay, so again, that was the whole action of the day that I've never been on an oil site or a field like this before. I'm appreciative to Bill and Scott for having us today. What we're going to be doing next is just all that information that you saw when we're out there walking. I think the biggest key that people did when they're getting into something like this is they just don't know which questions to ask. They just don't know what they don't know. So what we'll do is you'll see me back in the office on the second part of this video. It's going to be maybe another 15 or 20 minutes. But Bill and I are going to get on a Zoom call, and Bill's going to share his screen and kind of go over the actual numbers and, you know, look at the documents and what everything kind of entails to getting involved in one of these sites. Again, it's not for everybody. It's not my job to tell you what to do or not to do, really. I don't even know all the answers to this stuff. That's why I'm only going to defer whenever you have this desire to learn more. I'm going to defer you to speak directly with Scott and Bill because they are the experts. I'm not, but I know that this is a really cool opportunity in a very low risk way of getting into oil and gas because like we said earlier, the intimidation out of the gate because they think of, you know, these huge wells off, you know, down in the Gulf of Mexico. They think of Deepwater Horizon. They think of all these over the top, again, overwhelming ways of investing. And as you could see today, just walking, I'm like, it lowered my barrier to entry, I guess. I'm thinking, man, this is something more digestible, a way that someone like me, who's not a major league player, I'm not a publicly traded company, can get involved in investing in oil and gas, extracting it out of the ground without going and exploring a new well, but just putting, you know, these wells back online. So like I said, the second part of this video is going to be Bill and I going over all the numbers and the metrics and the ratios that you need to see if this is for you or not, and then we'll just direct you to straight to Bill and Scott, and you can ask all the more questions that you have if that's something that you have interest in. Now that we were on site, everything is tangible. Run us through the numbers and the math and show us on paper what we're looking at the opportunity wise.
To get them more into the program that we're offering, we're raising capital to deploy into these wells, and we're partnering with investors to reap the benefits of the oil and gas that we're extracting, and to take advantage of the great tax write-offs that come along with it. This is where we're at. This is the name of the joint venture. We structured it as a joint venture, so it allows us to get the tax write-offs. Pampa, Ram, joint venture, some forward-looking statements. And this is where we're at. We were up there, like you said, near Amarillo. The actual name of the town is called Pampa. And this field was originally discovered back in the 1930s. It's been drilled out. It's produced close to 1.4 billion barrels of oil. So to get more into the program, I mean, we talked when we were in the field a lot about the details of what we're actually doing. Here's a rundown of what the actual investment or the participation looks like. What we've done is we've structured it so that people are buying into the joint venture, and we've divided it into units, where one unit buys you 9% working interest across the 20 wells that we're redeveloping. 9% working interest comes out to 7.2% net revenue interest. And the net revenue interest just takes out the royalty owners and various costs. So that's a net number. So one unit price, we price it out at $550,000, and there's 10 units. So it's a $5.5 million raise. Right now, as of this morning, we've raised just a shade over $3 million. So we're over halfway funded, which is great. We've actually already started work on the first 3 wells. We started about a week and a half ago, and those 3 wells are producing right now. And we're getting ready to work on another 3 wells. So we'll close this program out at the end of November. The minute we start selling oil, When our tanks start to overflow and we have to actually sell that oil, then we have to close the program down because we no longer get the tax write-off for any investor that comes in because the capital is technically no longer at risk. It's a producing asset at that point, which is good, which is good. So that's kind of the structure. And this is really the meat of it. Someone asked me, Bill, what am I investing in, right? It's like I said, one unit buys you 9% across the 20 wells, $550,000 in a unit. And we take incremental units, taking quarter units, eighth units, even small, little smaller than that. But generally speaking, investors are coming in between a half unit, which is $275,000, and one unit, $550,000. And this is a conversion table. And all this simply does, it converts production from the wells back into dollars to an investor's pocket. On the top half, we have a monthly basis, and the bottom half, we have it over the life of the well. I'll get into the life of the well a little bit after this. We don't anticipate going for the life of the well. We anticipate becoming an acquisition target much before, a lot sooner before that, so we can sell out and get all of our capital back all at one time. But let's look at the top of the table. I said on the left-hand side, we have production rates. So we have 20 wells. On a conservative basis, we're looking at anywhere between 5 and 10 barrels of oil per day per well once we apply our techniques in revitalizing these wells. We did 5 barrels of oil per day per well, 20 wells. That's 100 barrels of oil per day. On the left-hand side of that, under production rate, drop down to 100. Go over to the middle column, which is one unit, based on a table of $75 oil. Today, oil is trading right about $72, $73 a barrel. We feel like $75 is a good price. That's a monthly return potential just around $14,000 or 32% annualized cash on cash, and does not include the tax rate. In other words, a fellow investing $550,000, once all is said and done, once we're producing, fella could see anywhere between $14,000 and $15,000 per month, depending on what the price of oil is. Now, that's a conservative number. Some of our wells are coming in the mentioned. We started work on 3 wells already. 2 of the wells are averaging between 8 and 12 barrels of oil per day once we applied our technique. So you can extrapolate there. This is based on 5 barrels of oil per day. If we went up to 200 barrels or 10 barrels of oil per day per well, 20 wells, follow me, take that up and double that amount. So now we're looking at 200 barrels of oil per day. That's a monthly return potential of over $30,000 or 66% annualized cash on cash.
Wow.
And doesn't include the tax write-off. Tax benefit is a super benefit that comes along with investing in oil and gas. Promotes oil and gas exploration. And in 2017, I think I mentioned this when we were up in the field, President Trump, at the time, had written an executive order declaring that any investment in oil and gas received 100% write-off in the first year. Prior to that, it was 80% in the first year, with the remaining 20% being amortized over the next 4 years. And you don't have to take it all up front in the first year, but it's very nice to get that K1. We issue our K1s right around the end of January, beginning of February. So any fellow investing today, October, November, fourth quarter, will get that K1 the end of January, beginning of February. And it's nice to get that K1 showing an immediate loss. And people say, well, I don't like losses. Well, it's an accelerated loss or depreciation. Similar to your world, but it's accelerated.
Well, what I would say then, Bill, and for those that are watching, is the next steps here are to get with you. That would be the next, and we'll put like the link on how that would, on what those next steps look like. But again, the conversation is very similar to what we've been going. Bill and Scott and those guys are extremely transparent with what they do. Like you said before, it's the whole point is you can say oil is risky, but Those guys are out there swinging for the fence to hit grand slams. You guys are just consistently getting on base. I mean, getting on base, you still score runs. You know,
Exactly.
score runs to win ball games. You know,
That's
period.
the perfect baseball analogy, Nolan.
Yeah.
It really is, and we're happy. We're more than happy to be transparent about it. Uh, like I said, we have begun work on 3 wells, and we're getting ready to work on another 3 wells here in the next week or so. But once we start the work, we send daily updates out. We get a daily report from our engineers in the field, our engineer and our geologists, showing what's been done. And it can get kind of boring at one point, say this is what we did, but we like to be transparent and send once we send the work out, once we start the work, we want to be able to send an update so the investors know that, hey, my money's actually going to work, and we can start reaping the benefits of these great oil prices.
That's right. And another piece on what you said too is, like you said, you're not a publicly traded company. So in my
No.
opinion, I'm not either. And with my real estate, I pay attention to the details because if you save the nickels and dimes, the dollars will save themselves. Like I focus on very tedious, like focusing on my small business like it is my world. So when you guys are potentially investing with Bill, you got a guy that gives a shit. He's a guy that's focused on the paying attention to the details, and that's so important in a business that can be this profitable. So, yeah. So
I
again, Bill,
love that.
thanks for making
This
an
is
offer.
this is our baby, Nolan. I
Yes.
don't mean to cut. This is our baby, and keep in mind that we've got our own capital. We've got a ton of capital in this, and we own a 10% of the JV. The investors own 90%, so the payout's 90-10, but we own 10%. So our success obviously is everyone else's success. Everyone's success is our success. So
Yeah.
we're all rowing in the same direction, and we want nothing more than to hit you know not even singles and doubles, maybe a couple of triples in there.
Yeah, there you go.
So, we're pleased. We're looking forward to the work that we've done so far, and we're very, very happy with the results we've got thus
Yeah.
far.
Extremely bullish to be partnering with you guys and excited for what's to come in the future. So again, as we get going, guys, when you guys have more questions and you want to jump on a call directly with Bill, he is more than happy to do that as soon as you're ready to learn more information. So Bill, thanks so much for making it on, man. We're excited for our new partnership.
You bet, Nolan. Great meeting you, and can't really look forward to working with you and getting this off the ground.
Yeah, man.
Thanks so
Excited
much.
for what's next. Thanks so much, Bill.